Hey everyone, welcome back. And if you are new here, welcome. Before we start, thank you. This channel is growing because of you. Every view, every comment, every subscribe, I do not take that for granted. Now, what I am about to show you is something almost nobody is talking about. Let's get into it. There's a strip of water in the Middle East that is 33 kilometers wide. 33 kilometers. You could swim across it in a few hours if you tried, and every single day, 20 million barrels of oil pass through it. That is roughly 20% of everything the world consumes, every single day. It is called the Strait of Hormuz. And right now, it is the most dangerous place on Earth for your wallet. Here is why. On February 16th, parts of the strait were temporarily closed. For several hours, tankers could not pass. Oil prices jumped 7% in 48 hours. Brent crude hit a 6-month high, 7% in 2 days, because a few hours of closure sent the entire global energy market into a panic. Now ask yourself, what happens if it closes for a week, a month, or longer? Goldman Sachs published a note saying oil could top $100 a barrel if the strait were blocked. Lombard Odier, a Swiss bank, said a temporary spike to $100 or beyond is plausible. And Fortune magazine reported that the price of gasoline in America could go from $2.93 today to $5 a gallon in the scenario everyone is trying to avoid. $5. That is not a prediction. That is the number analysts are using for the worst case scenario. And even the moderate case, not the worst, just a sustained period of higher tensions, has oil at 85 or above. Before the numbers, some context, because this is not the first time oil prices nearly blew up because of this strait. In 1973, during the oil embargo, prices quadrupled in 6 months. Gas stations ran out of fuel. People waited in line for hours just to fill up their tank. Inflation in America hit double digits. It took nearly a decade to recover. The U.S. economy shrank, unemployment doubled, and the Federal Reserve was stuck. It could not lower rates to help growth because inflation was already out of control. That period gave the world a word that still makes economists nervous: stagflation. In 2008, oil hit $147 a barrel. Gasoline hit over $4 a gallon. That spike added pressure to an economy already weakened by the housing collapse and made the downturn worse for ordinary consumers. In 2022, after events in Eastern Europe disrupted energy flows, oil briefly hit $130. Gasoline averaged over $5. Inflation hit 9.1%, the highest in 41 years. Every single time oil spikes, the same thing happens. Everything else gets more expensive, and ordinary people pay the price. Now it is happening again. Except this time, the choke point is not a pipeline in Europe. It is a 33-kilometer strip of water that carries 20% of the world's oil. Here is the perspective. Because this is not about geopolitics. This is about your grocery bill. The Strait of Hormuz sits between the Persian Gulf and the open ocean. Iran is on one side. Oman and the UAE are on the other. At its narrowest point, the shipping lanes fall within territorial waters. That means any country on either side has legal and physical influence over what passes through. Every day, about 3,000 vessels move through this channel. They carry crude oil, liquefied natural gas, fertilizers, copper, and aluminum. About 84% of the oil that passes through Hormuz goes to Asia. China, India, Japan, and South Korea together receive about 69% of all crude flowing through the strait. India gets nearly half its crude oil imports and about 60% of its natural gas through this one passage. Japan gets almost all its oil from the Middle East. South Korea, same. These are the second, third, and fourth largest economies in Asia, and they all depend on this 33-kilometer gap. Even China, which has been diversifying its energy sources for years, buying Russian oil through pipelines, building solar farms at record pace, still imports millions of barrels a day through Hormuz. No amount of diversification has eliminated that dependency. If that gap narrows, if tankers slow down, if insurance rates spike, if shipping companies reroute, the price of everything goes up. Not just oil. Everything. Because oil is in everything. It is in the plastic that wraps your food. It is in the fuel that delivers your packages. It is in the fertilizer that grows your vegetables. It is in the asphalt on your road and the tires on your car. When oil goes up 10%, it does not just mean you pay more at the pump. It means the truck driver delivering to Walmart pays more. The farmer growing corn pays more. The factory making your phone case pays more. And all of those costs get passed to you. The Energy Information Administration, the U.S. government's own data agency, said it plainly. There are very few alternative options to move oil out of the Gulf if the Strait of Hormuz is closed. Some Gulf producers have pipelines that bypass the strait. Saudi Arabia and the UAE can redirect a portion of their exports via the Red Sea or through the port of Fujairah on the other side of the strait. But the capacity is limited. Saudi Arabia and the UAE combined can bypass roughly 6 to 7 million barrels a day. The strait handles 20 million. The math does not work. And here is the part most people miss. 70% of OPEC's spare production capacity is located inside the Gulf. That means the spare oil that is supposed to calm markets during a supply shock is trapped behind the same choke point. The backup plan is stuck behind the same door. Here is what actually happened in the last 2 weeks, because it moved fast. On February 16th, a large-scale exercise was conducted in and around the strait. Parts of the waterway were closed for several hours. 22 zones were restricted. Drones and fast boats were deployed. On February 18th, a ship from Russia docked at a port on the Iranian side of the strait, Bandar Abbas, a key location. The same week, ships from 3 countries, Russia, China, and Iran, participated in joint operations in the same waters. The exercise was called Maritime Security Belt 2026. A senior Russian official said the exercise proved to be relevant. His words. At the same time, the U.S. Maritime Administration issued a warning advising commercial ships to stay as far as possible from Iranian waters while passing through the strait. That advisory is still active. And on February 3rd, just weeks before all of this, several fast boats reportedly approached a U.S.-linked tanker in the strait. That incident caused an immediate spike in risk premiums. Now, here's why this matters to you if you live in America, Europe, or anywhere that imports energy. Brent crude is trading around $70 today. That is already up 15% since the start of the year. WTI, the U.S. benchmark, is around $65.60. Gasoline in America averages $2.93 per gallon. That is already rising. And here's the math. If oil goes from 70 to 85, which multiple analysts say is possible if tensions escalate, gasoline goes to roughly $3.50 to $3.75 a gallon. If oil goes to 100, which Goldman and Lombard Odier have both flagged, gasoline could hit $4 to $4.50. And in the extreme scenario, a sustained closure of the strait lasting weeks, the estimates go to $5 or higher. For context, the last time gasoline averaged over $5 in America was June 2022. That was the highest on record. And it was one of the main reasons inflation hit 9.1%, the highest in 41 years. Higher oil means higher transportation costs. Higher transportation costs mean higher food prices. Higher food prices mean higher inflation. Higher inflation means the Federal Reserve cannot cut interest rates. And if the Fed cannot cut rates, mortgage rates stay high. Car loans stay expensive. Credit card rates stay near 22%. The economic relief everyone is waiting for gets pushed further into the future. Here's a real example. The average American household uses roughly 1,000 gallons of gasoline per year. If gas goes from $2.93 to $4.50, that is an extra $1,500 a year. Gone, just like that. That is $1,500 that does not go to restaurants, does not go to savings, does not go to the kids' college fund. It goes into the gas tank. And it is not just gasoline. When diesel goes up, and diesel always follows crude, the trucks that deliver everything to every store in America cost more to run. Those costs get passed to you in higher prices for food, clothing, electronics, and medicine. A $10 increase in the price of oil adds roughly 25 cents to the price of a gallon of gas. But it adds pennies to the price of everything on every shelf in every store. And those pennies add up to hundreds of dollars a month for the average family. This is the chain reaction. And it starts with a 33-kilometer strip of water. But it is not just about the oil price, it is about the insurance. When risk goes up in a shipping corridor, insurance premiums for tankers skyrocket. We saw this with the Red Sea disruptions in 2024. Activity in the Bab al-Mandeb Strait caused shipping companies to reroute around Africa, adding 10 to 15 days to every voyage. Insurance costs for transiting the Red Sea went up by over 500%. Some insurers refused to cover ships at all. If the same thing happens in Hormuz, and the risk is real, the cost of moving oil doubles before the oil itself even gets more expensive. And it is not just oil. The strait carries about 1/5 of all global liquefied natural gas shipments. Qatar, the world's largest LNG exporter, ships almost everything through Hormuz. Natural gas heats homes in Europe, powers factories in Asia, generates electricity in countries that have moved away from coal. If LNG shipments slow down, energy prices spike everywhere, not just at the gas pump. Lombard Odier specifically flagged this. They said global LNG prices would also be affected by any disruption. And for countries like Japan and South Korea, which import virtually all their energy, a Hormuz disruption is an existential economic threat. And that cost gets baked into everything, every barrel, every shipment, every product on every shelf. The shipping industry is already on alert. Peter Sand, the chief analyst at Xeneta, a major freight pricing platform, said carriers will now have to plan for elevated risk of disruption. He said the political tensions are likely to stick around. Stick around. That is the key phrase. Because even if the strait stays open, the uncertainty alone is enough to keep prices elevated. Traders call it the risk premium. It is the extra cost the market adds to oil just because something might happen. And right now, that premium is baked into every barrel. To put a number on it, oil was trading in the mid-50s at the start of this year. It is now around 70. That $15 jump is almost entirely risk premium, not because supply fell, not because demand surged, but because the market is pricing in the possibility that something goes wrong in the Gulf. That means consumers are already paying more because of uncertainty, not because of an actual disruption, just the fear of one. Vanda Insights, the chief executive of Vanda Insights, said the market remained intensely focused on the risk of the situation in the Gulf. That focus is not going away anytime soon. Here is what could make this better, and what could make it much worse. The better scenario: talks in Geneva produce a result. Both sides have described recent rounds as positive and a step forward. If a deal is reached by March, the risk premium evaporates. Oil could fall back to the mid-60s. Gasoline stays below $3. Everyone exhales. The worst scenario: talks collapse, the risk premium spikes, oil heads toward 85 or 90, and if the strait is physically disrupted, even briefly, $100 becomes the floor, not the ceiling. An analyst at one investment firm put it this way: nothing would offset a sustained closure of the Strait of Hormuz. It is simply unsustainable for global energy markets. And here is the detail that ties this back to the bigger economic picture. Remember the tariffs. The US has imposed 10 to 15% tariffs on goods from around the world under Section 122. Those tariffs are already raising the cost of imported goods. Now add higher oil prices on top of that. You get a double hit. Higher energy costs plus higher tariff costs equals higher prices for everything. Economists call it stagflation, rising prices with slowing growth. It is the worst combination for consumers and the hardest problem for central banks to solve. One analyst described it as a pincer movement on the global economy. Oil squeezing from one side, tariffs squeezing from the other, and consumers stuck in the middle with nowhere to go. OPEC is scheduled to meet this weekend to discuss April production plans. They may continue with planned output increases, which would add supply to the market and help keep prices in check. But OPEC's ability to stabilize prices depends on the strait staying open. But because most of OPEC's spare capacity, Saudi Arabia, UAE, Kuwait, Iraq, exports through Hormuz. Saudi Arabia alone ships roughly 5.5 million barrels a day through the strait, more than any other country in the region. If the door closes, OPEC's spare oil stays in the ground. The one tool the world has to cool oil prices becomes useless. And even if the strait stays open but insurance costs make transiting it too expensive, the effect is the same. Oil does not have to stop flowing physically. It just has to become expensive enough to flow that the price at the other end reflects that cost. During the Red Sea disruptions, no oil actually stopped flowing. Ships just rerouted. But the extra time and extra insurance added dollars to every barrel. The same thing is already beginning to happen in the Gulf, and it has barely been noticed. And there is one more factor nobody is talking about. The US just reported a 16 million barrel build in crude inventories, the largest in over 2 years. That sounds bearish. It sounds like there's plenty of oil. But here's the thing. All of that oil is already in America. It does not help Asia. It does not help Europe. And if the strait disrupts flows to Asia, which receives 84% of Hormuz oil, US inventories do not fix the problem. The surplus is in the wrong place. The risk is in the wrong place. And the prices are set by the place with the most uncertainty. So what should you be watching? 3 things. First, the Geneva talks. If a deal is reached, oil drops. If talks collapse, oil spikes. This is the single most important variable for energy prices in the next 30 days. Second, shipping and insurance data. If insurance premiums for the Gulf start climbing, or if major shipping companies start rerouting, that is an early signal that the market is pricing in a disruption before it happens. Third, gasoline prices at the pump. The national average is $2.93 right now. If it crosses $3.25, the squeeze is underway. If it crosses $3.50, the Fed's rate cut timeline is in trouble. And if it crosses $4, inflation is back in the headlines. And this connects to the bigger picture, because this does not exist in a vacuum. The US economy is already fragile. We talked about this in a previous video. The job market created almost no jobs last year. The bottom half of American consumers is struggling. Household debt is at a record. Credit card delinquencies are rising. That economy, the one already on thin ice, is now facing a potential energy price shock. And there is no buffer. The savings built up during the pandemic are gone. Real wages have only just caught up with prices. Consumers are stretched. If oil goes to 85 or 90, it is not just an energy story. It becomes an economy story. It becomes a recession story. Moody's already puts recession probability at 42%. JP Morgan says 40. Add an oil shock to those numbers and the math gets very uncomfortable. And for people in Asia, This is even more serious. China imports over 10 million barrels a day. India imports about 5 million. Japan and South Korea are almost entirely dependent on imported energy. A disruption in Hormuz does not just raise their energy costs. It slows their factories, it raises their consumer prices, it weakens their currencies against the dollar, and it slows global trade, which slows the global economy, which comes back and hits American exporters. This is what interconnection looks like. A 33-kilometer strait on the other side of the world affects the price of bread in Ohio. The world got used to cheap, reliable energy flowing through this passage for decades. Nobody planned for what happens when it stops. The strait is open today. Oil is flowing. Tankers are passing. But the margin of safety is thinner than it has been in years, and the number that matters most is not on a stock chart or a GDP report. It is 33 kilometers. Now, this channel will be covering the Geneva talks, the OPEC decision, and the next oil price moves as they happen. If things escalate, the breakdown will already be here. If things calm down, that update will be here too. But most people will not see that video. They are not subscribed. They will find out 3 days late, after the price already moved, after the damage was already done. If you learned something from this video that you did not know before, hit subscribe. It is free. It takes 1 second. And it means the next time something moves, you hear about it while there is still time to prepare. See you in the next one.